On February 12th, at exactly 11 a.m. Eastern Time, silver crashed 9% to $76.57 in a matter of minutes. The trigger? A leaked Kremlin memo obtained by Bloomberg revealing Russia might abandon its anti-dollar crusade and embrace the greenback again. Saturday, February 14th, 2026, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. So what really happened on February 12th? And more importantly, what does it mean for anyone holding silver right now or considering buying into this chaos? Because make no mistake, this isn't just another dip. This is the latest chapter in what's becoming one of the most volatile periods in silver's modern trading history. And the geopolitical implications reach far beyond just precious metals markets. The sell-off was absolutely brutal. Silver didn't just decline gradually throughout the day, it fell off a cliff in minutes. Gold dropped 2.6% to $49.49 simultaneously. Mining stocks got obliterated. GDX fell 5%, SILJ dropped 6.5%. Traders watching their screens described it as a flash crash, with volume spikes that lit up every trading terminal on the floor. Futures markets saw cascading liquidations as stop losses triggered one after another, creating this self-reinforcing downward spiral that nobody could stop once it started. And the timing? Exactly when Bloomberg published their bombshell report. Not an hour before, not an hour after. The precise moment that story hit the wires, silver began its nosedive. That's not coincidence. That's the market pricing in a fundamental shift in the geopolitical landscape, or at least the possibility of one. Here's what Bloomberg found. They obtained and reviewed an internal 2026 Kremlin memo that's been circulating among senior Russian officials. This isn't some rumor or speculation from anonymous sources. Bloomberg actually got their hands on the document, and what it reveals is nothing short of stunning if it's legitimate. Russia is seriously considering re-embracing the US dollar as its reserve currency, as part of a broader economic partnership with the Trump administration. Think about that for a second. This completely reverses years of aggressive de-dollarization efforts that Russia has been pursuing since the sanctions regime began. The context here is critical. Russia had shifted 90% of its trade with China and India to national currencies: yuan, rupees, rubles. The dollar was being systematically removed from their bilateral trade relationships. BRICS nations collectively moved 60 to 67% of their mutual trade to local currencies, bypassing the dollar entirely. This was considered by many analysts to be one of the single biggest geopolitical threats to US dollar hegemony. The idea that a coalition of major economies representing billions of people could create an alternative financial system that doesn't run through New York? That kept people at the Federal Reserve and Treasury Department up at night. The memo outlines what's being called a fossil fuel-first economic partnership between the United States and Russia. 7 key points focusing on natural gas cooperation, offshore oil exploration, and most importantly for our purposes, shared control of critical raw materials. We're talking about palladium, nickel, titanium, rare earth elements. Russia holds the world's largest reserves of these strategic metals. These aren't luxury goods. These materials are absolutely critical for U.S. aerospace, defense, and technology companies. Without Russian supply, American industries face severe bottlenecks that could cripple entire sectors of the economy. This creates mutual dependence that actually makes sense from a transactional perspective. Trump gets access to critical materials that American companies desperately need. Putin gets an economic lifeline and a path back into the global financial system after years of isolation. The U.S. is the world's leading consumer of industrial commodities. Russia is among the world's leading producers of those same commodities. Neither leader has particularly strong ties to current European leadership structures. A U.S.-Russia economic axis could genuinely reshape global trade flows in ways we haven't seen since the end of the Cold War. But here's where it gets complicated, and this is what the market is struggling to process right now. Trump himself has repeatedly said he wants a weaker dollar. On January 27th, he stated that a weaker dollar is great for American competitiveness. Back in summer 2025, he said a weak dollar helps America make a hell of a lot more money on exports. Yet now, if Russia embraces the dollar and abandons BRICS de-dollarization efforts, that would likely strengthen the dollar significantly. So does Trump actually want what this deal would deliver? That's the paradox at the heart of this entire situation, and nobody has a good answer. Now let's put this crash in context with what silver has been doing over the past few weeks. On January 29, 2026, silver hit an all-time high of $121.63, a level never seen before in history. People were calling it the silver rocket ship. Social media was flooded with predictions of $200 silver, $300 silver, and then within 24 to 48 hours, on January 30th through 31st, it suffered a catastrophic 36% intraday crash, one of the most violent moves in silver's modern trading history. Chinese speculative traders were blamed for both the parabolic rally and the brutal sell-off that followed. These traders were using massive leverage, up to 10 to 1 or even higher, on Chinese commodity exchanges. When you're that leveraged, even a small move against you can wipe out your entire position and force liquidation. Scott Bessent, the U.S. Treasury Secretary, did something unusual. He explicitly called out Chinese traders for causing what he termed a speculative blow-off. Government officials typically don't comment on specific commodity moves like this. The fact that Bessent did signals how concerned the U.S. government is about commodity market manipulation and speculation that can destabilize broader financial markets. CME Group, which operates the major U.S. futures exchanges, increased margin requirements during the volatility. This forced leveraged traders to either put up more capital or liquidate their positions. Most couldn't put up more capital, so they liquidated. That created this self-reinforcing downward spiral where forced selling begat more selling, which triggered more stop losses, which created more forced selling. It's a dynamic that anyone who trades volatile assets knows and fears. As of February 13th and 14th, silver is trading around $77.54 to $77.62. Still down roughly 36% from that peak we saw just 2 weeks ago. But perspective matters here, and this is something that gets lost in the panic. Silver is still up over $40 to $45 compared to early 2025 prices, when it was trading below $32 to $35. 2025 saw silver gain 147%, the best annual performance since 1979. Year-to-date 2026, despite these violent crashes, silver is still positive if you measure from January 1st. The question everyone's asking is whether this Bloomberg report and the Russia situation represents a fundamental regime change or just another geopolitical trial balloon that goes nowhere. Can one internal memo really reverse years of infrastructure building? BRICS nations have invested billions in alternative payment systems. China's CIPS, the cross-border interbank payment system, is fully operational and processing real transactions every day. Russia and China have deep financial integration that can't simply be undone overnight with a handshake and a press release. Countless peace proposals and deals have been floated during the Ukraine war. None materialized into anything substantive. Is this different? Maybe. The difference here is that this isn't just about ending the war. It's about restructuring the global economic order in a way that benefits both the United States and Russia, while potentially sidelining Europe and undermining BRICS. That's a much bigger prize for both Trump and Putin than any simple peace deal. But Putin has repeatedly stated, publicly and privately, that Russia will never trust the West again after the sanctions regime. Can that level of distrust really be overcome with a fossil fuel deal and access to critical materials? That's genuinely an open question. Trust, once broken at the nation-state level, doesn't just come back because it's economically convenient. Meanwhile, the fundamental picture for silver itself hasn't changed. The supply deficit continues. Projections for 2026 show a deficit of 67 to 200 million ounces, depending on whose analysis you trust. This marks the 6th consecutive year of supply shortfalls. Since 2021, the cumulative deficit exceeds 900 million ounces. That's a staggering amount of silver that's been consumed and isn't coming back into the market. Mine production remains essentially flat around 830 million ounces annually. 70% of silver comes as a byproduct of copper, lead, and zinc mining. You can't just decide to produce more silver because prices are high. If the copper mine isn't expanding, the silver production from that mine isn't expanding either. Industrial demand remains robust at roughly 650 million ounces annually. Solar panels alone account for 196 million ounces for photovoltaic cells. Electric vehicles use 50+ grams of silver per vehicle, versus 15 to 20 grams in traditional combustion engines. AI and data centers are emerging as a major new demand pillar that wasn't even on anyone's radar 5 years ago. Physical silver markets are showing real tightness. COMEX inventories are declining. London lease rates are elevated, which indicates that people who need physical silver for industrial purposes are having to pay a premium to borrow it. ETF holdings remain steady around 847 million ounces. Institutional investors haven't fled. That tells you something about long-term conviction versus short-term trading noise. The Federal Reserve is expected to deliver 60 basis points of rate cuts by the end of 2026. Recent economic data shows softness. Retail sales stalled in December 2025. A weaker economy typically leads to more dovish Fed policy. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. This is fundamentally supportive for precious metals over the medium term, assuming the Fed follows through. So what happens next? I'm going to lay out 3 distinct scenarios with honest probability assessments, and I want to be clear that I don't know which one will play out. Nobody does. Anyone telling you they know with certainty is either lying or delusional. The bullish recovery scenario, which I'd assign maybe 40% probability, looks like this. Russia deal talks collapse like previous attempts during the Ukraine war have collapsed. Trump actually implements the weak dollar policies he's publicly advocated for, rather than accidentally strengthening the dollar through this partnership. The Fed cuts rates more aggressively than currently expected, as the economy slows more than anticipated. Chinese economic stimulus reignites industrial commodity demand. In this scenario, silver reclaims $85 within 4 to 6 weeks, challenges $100 by mid-year 2026, and potentially reaches $110 to $120 again by Q4 if the supply deficit worsens and industrial demand surprises to the upside. Physical silver shortages become more apparent, causing a paper-physical disconnect, where people holding physical metal can demand significant premiums over the futures price. Investment demand returns as inflation fears resurface later in the year. The bearish continuation scenario, maybe 30% probability, plays out differently. The Russia-US partnership actually materializes and proves substantive. Trump and Putin announce concrete deals on energy and critical materials at a summit. The dollar strengthens significantly on this news, and the Fed holds rates higher than expected because the economy proves more resilient. Other BRICS nations start to waver in their de-dollarization efforts, further supporting the dollar. In this scenario, silver breaks the $75 support level, slides to 70, and potentially tests 65 or even 60 if the momentum turns severely negative. Industrial demand proves weaker than expected as the global economy slows. Mining companies manage to increase production despite low margins, adding supply pressure. ETFs see outflows as investors rotate out of commodities entirely. The sideways consolidation scenario, also around 30% probability, is perhaps the most frustrating. The market enters wait-and-see mode as the Russia situation remains ambiguous. No clear breakthrough in negotiations, but no complete collapse either. Silver trades in a wide $75 to $90 range for 3 to 6 months, while the market digests the volatility and geopolitical uncertainty. Neither bulls nor bears gain lasting control. This range-bound trading frustrates both momentum traders looking for big moves and long-term investors who want confirmation of direction. Eventually, some catalyst breaks the range, either a fundamental supply crisis pushing prices higher or macro headwinds pushing them lower. The physical market and paper market continue to diverge, with physical showing premiums, while futures remain under pressure. What should you actually do with this information? That depends entirely on what type of investor you are. For short-term traders, this environment is absolutely treacherous. 5 to 10% daily swings are possible. You need tight stops, smaller position sizes, and you cannot fight the tape. If 75 breaks, don't try to catch a falling knife. If we reclaim 85 with real conviction and volume, that's a momentum buy signal. Watch the dollar index as your leading indicator. For long-term physical stackers, if you believe in the structural supply deficit story and industrial demand growth, these crashes are opportunities to accumulate at prices that were unthinkable 18 months ago. Dollar cost average rather than trying to time the exact bottom. Focus on reputable dealers and secure storage. Remember that physical premiums often stay elevated even when paper prices crash. For mining stock investors, miners have been absolutely destroyed. Many are down 50 to 60% from recent highs. But if silver recovers even modestly to $85 or $90, these stocks could double or triple from current levels due to their leverage to the underlying metal. However, if silver falls to 65 or 70, many miners become marginal or unprofitable. This is the highest risk, highest reward option. Consider waiting for technical confirmation of a bottom before deploying significant capital. Here's the deeper question that goes beyond trading and positions. Zoom out from the day-to-day noise and market hysteria. Is this crash a temporary geopolitical scare that will fade when reality sets in and Russia doesn't actually abandon BRICS? Or is this the start of a fundamental regime change where the dollar reasserts dominance and we enter a prolonged commodities bear market? The honest answer is probably somewhere in between, but your position sizing should reflect genuine uncertainty about which path we're on. Nobody knows with certainty what Trump and Putin will ultimately do, or whether any deals they announce will actually stick. The market will remain volatile and news-driven in the near term. Those who can stomach the volatility and think in terms of years rather than days may find genuine opportunities in this chaos. Those who need stability and predictable returns should probably look elsewhere because silver is not providing that right now, and likely won't for the foreseeable future. The only certainty is uncertainty, and in markets, that's often when the most significant moves happen in either direction.